Fannie Mae just got rid of the 620 minimum credit score. And I bet you might have missed that in a busy week of news. This is your host, Ron Wysokarski, for the Black Hole of Real Estate. And at a time where we were so focused on things like Fed meetings and government shutdowns and housing reports that we might just have missed, Fannie Mae on the 16th of November did away with the 620 minimum credit score. And for some borrowers, this is really good news. And for others, especially like underwriters and loan officers, kind of like, eh. So here's what's going on. For years, you had to have 620 as a minimum score. You had to have that number. And for someone that maybe had some credit card debt that was in use, maybe a medical collection or something like a one-time deal that really drops your credit, because that can happen. You know, if you miss something on medical or it gets reported, and there's times where you don't even get the bill and it shows up in your credit, or even like something wrong, and that could drop 50 or 100 points off your score. It's real. It's because it's new, and I'll explain why that is so impactful. But now that's been wiped away, so score is no longer your enemy, if you will. But we still have to think about things like debt-to-income ratio and loan-to-value ratio. So those are still in play. But let me spin back. So like if you got a credit blemish, one of the components of your credit score is on-time payments. Another one is length of credit history. So if you've been a student loan for 5 or 10 years, and a car payment for 5 years, and a Visa card for 5 years, and if you got 3 or 4 trade lines, your average trade line might be close to 5 years. Could be longer. And the credit bureaus like to see 7, 8, 9, 10 for years. Now here's what happens. Let's say you've got 3 things that are 5 years each. And let's add that up. That's 15, right? 3 times 5 is 15. And now you get a brand new thing, and maybe it's a medical collection that you didn't know about it. Well, now you got 4 lines sitting out there, but all of a sudden that credit, if you will, is impacted because now it's bringing average age down, even because it's an account. And while it might go away, the credit bureaus look at that, and the underwriters look at it like, oh my God, there's instability. You didn't pay that $18 medical bill. You might default on your mortgage. And it just isn't the case. But that's how the scoring system works. So if you've got one of those, that isn't going to help you about minimum credit score as far as qualifications. What it will do, though, is wipe out the fact that maybe you went from a 660 to a 590 or a 619 or some number below 620. So now that's off the table. So that weird medical collection, that weird cable bill that you got charged for that you shouldn't have when you moved out of a place, those go away to an extent, because they're no longer looking at 620 as the line in the sand for loan approvals. So now that just about anybody can apply, now it just goes back to your credit worthiness. Provable income. Most lenders want to use about 45%. So in a vacuum, if you made, $10,000 a month, only because it's a round number, $4,500 of which could be used towards all of your bills. That's your car payment, your Visa payment, your student loan, and your housing payment, all lumped together. So, okay, well, not everybody makes $120,000. I have an idea. Let's just cut it in half. And if you have $50,000 income, it was $4,500. Cut that in half, $2,250. So now we're in a situation where your car payment, your Visa, your student loan have to fit under $2,250. And for most people, that's a bit of a tight squeeze with the median sales prices the way that they are. So this is really going to be the ongoing issue. It always has been the issue. It's the debt-to-income ratio. Your napkin math, if you will. Whatever you make, W-2 income, gross, not after taxes, before taxes. Take that number, divide it out by 12, and that's the number that you're working with. So if you make $72,000 in numbers, $6,000. If you multiply that by 45%, it's $2,700 a month. You got a little more room to work with, and so on. So keep looking at that number. But that's, in an extreme case, let's say that you had an extraordinarily high credit score, like 800, and your debt-to-income ratio was closer to 50%. You probably get an exception, through underwriting. And what that would look like is, same example. At $50,000, you could only really go up to $5,000 a month, right? $60,000 divided by 12 months, $5,000. 45% of that's $2,250. But with really good credit and maybe some reserves in a 401k or something else, maybe get to 50%. Now it gives you like $3,000 to work with, right? Well, actually $2,500 in this case, because it's $60,000 divided by 12 is $5,000. Half of that, $2,500. In the other example, if you were at $72,000, income $6,000 per month, cut that in half, that's $3,000. So that gives you a bit of a sweet spot of where you can at least do the math in the air of what you might be able to qualify for, and then work backwards. So let's just say you had $3,000 to work with, and your student loan is $500. Well, now you got $2,500 to work with. And then you've got a car payment for $500. Take that out. Well, I got $2,000 left to work with. And if your credit cards are all paid, that $2,000, that's PITI. Principal, interest, taxes, and insurance. That's got to add up to $2,000 or less for you to qualify for the loan. If you find that that number is not working, what it means is you either need a lower interest rate, a lower priced house, or both. So the 620 credit score, it's great for a lot of people that were dinged unnecessarily or just inadvertently over some credit mishap that really didn't amount to a hill of beans. But ultimately, you still have to qualify on the debt-to-income ratio. Now, the other one's loan-to-value ratio. If it's FHA, only a 3.5% down payment. It's 96.5% mortgage. Now, there's going to be mortgage insurance on there if it's below 20% down, so that has to get calculated in with the PITI, principal, interest, taxes, and insurance, plus mortgage insurance. It's all got to fit underneath that level. And the good news is, for some people, there is availability to have no money down. VA is the one way that is easy. You need a DD-214 and eligibility certificate. So if you're a veteran, just those two things, and you can be on your way to a no money down home loan. And the other way is what they call a rural housing loan. So you can look into that as well. And that really would be for underserved area. You can type that right into the internet and look at rural housing loans, and that's going to be able to give you a really good idea of what that zero down payment loan looks like. So there's a couple of those examples. Keep in mind that you can also get help on your closing costs. Up to 4% on the VA loans, and then at least 3% on FHA, times 6%. But usually 3% seems to be that one that really, really works for most people. But going back to the big news is this. As of November 16th, the minimum credit score of 620 has been wiped out by Fannie Mae. And what that means is a lot more people are going to be able to qualify with lower credit scores, and it's absolutely a step in the right direction for consumers. Now, if we get rates down just a little bit and incomes to go up a little bit more, will we really on to something? Well, the future actually is looking really good for the housing industry and the real estate market specifically when it comes to buyers and sellers getting back in the game at the end of 2025, and definitely a nice runway into 2026. If you got questions about how these financing things work, drop us a line, give us a comment, and definitely subscribe so we can help you more on everything that matters when it comes to real estate. This is Ron Wojciechowski for the Black Hole of Real Estate.